Hi, and welcome back to our next session in the Social Security Maximization course, a Yields for You Retirement Readiness course. In today's video, we're going to be discussing the 5 ways that the government can reduce your Social Security benefits, and what are some of the steps you can take to minimize or eliminate those reductions. For those of you who don't know who I am, my name is Label Sternbach. I am the founder of YieldsForYou.com. We specialize in helping people transition into and through retirement. For the last 12 years, I've been working with advisors across the country, and I've recently fallen in love with online learning. So I thought to myself, why aren't there any good retirement courses? Planning for retirement is such an important task, yet there is nowhere online where you can go to find an educational course on retirement planning. It seems like every advisor out there is trying to sell you some product or service, and they provide some information, and more often than not, the information is biased towards the product or services they offer. So I started YieldsForYou.com, a fee-only financial planning firm. We don't sell product, and we aren't looking to manage your investments. We are holistic financial planners, and we do 2 things, and we do them really well. 1, we teach people how to plan for retirement, and we show them how to stay retired. And 2, we help our students implement those plans and keep them up to date as the times change. As I've mentioned in previous videos, there are 3 parts to this course. There is the theoretical knowledge, there is the maximization report, and the one-on-one strategy session. During the one-on-one strategy session, we will take the theoretical information from the course, the data from the maximization report, and we're going to figure out how to best implement it in your life. Okay, before we get started, I wanted to take a minute and discuss something important. If everyone who is eligible for benefits actually claimed their full benefits, the government would be forced to raise taxes pretty quickly. The truth is that most government programs only deliver a fraction of their promise. The way the government is able to do this is by implementing what are called shadow policies. These have the net effect of reducing the number of people or the amount of benefits people are eligible for. For example, simply requiring people to fill out an application for benefits significantly reduces the number of people who apply. Think for a second. The government knows if you're eligible for Social Security. Why then do they not automatically enroll you? The answer is simple. There's a group of people who will never take action. You put a simple stumbling block in their path, a simple task they have to accomplish, and they just won't do it. Even though there is a pot of gold at the other end, they won't take that action. Or maybe they just don't know that they're eligible, like the countless people I talk to who don't realize that their stay-at-home spouses are entitled to benefits under their work record. So when we talk about benefit reductions, it isn't only the explicit reductions that they tell us about, but the shadow reductions that are buried in the fine print, or the programs or actions we have to take that would increase our benefits, but we didn't know that we could take them. This next slide is something that most people find surprising. If you're like most people, you probably think your retirement income is something like this bucket that you're filling up with Social Security, your investment returns, and maybe some time that you're working or pensions if you've got one. And in your mind, you just need to figure out how to make all those assets grow and last throughout your lifetime. But in reality, you're pouring all that money into a very leaky bucket. The government is slowly poking holes, poke, in your bucket, draining your hard-earned savings. They do this in the form of required minimum distributions, which translate into income tax revenue. They then use that taxable income to justify reducing your Social Security, reducing your eligibility for benefits, increasing your Medicare premiums, and those are just the obvious ways. So when we think about retirement planning, it's not just about getting the biggest check, but about patching those leaky holes in our bucket, which we'll discuss in depth later. Sorry, I got a little off track. As you can probably tell, this is a topic that really gets me riled up. If we take a step back, let's focus on the ways that the government is going to reduce our Social Security benefits. We'll leave the retirement planning for another day. When we look at Social Security, up to 85% of our Social Security benefits can be taxed if our combined income exceeds the thresholds listed. This so-called combined income includes 50% of our Social Security, right? Okay, so they're going to use our Social Security to determine whether our Social Security can be taxed, right? They're also including our tax-exempt interest, which is supposed to be not taxable, so we're not even paying taxes on it, but they're going to include it to determine whether they can tax our Social Security, right? So essentially, most people, unless they have done some good retirement planning, they'll have converted some or all of their assets to non-taxable assets. They will probably pay taxes on their Social Security. We'll discuss strategies for reducing your taxable income in later videos. The next way your Social Security check can be reduced is through something called the Retirement Earnings Test. Now, this is something that only applies when you're taking early retirement benefits. And it isn't exactly a reduction as much as it's a deferral of those benefits. Essentially, if you take Social Security benefits, the government is going to look at your earnings and reduce your Social Security check if you're earning above that $17,000 a year threshold. The good news is that once you reach full retirement age, those monies will be added back to your check. So if you're planning on taking early retirement, you need to really consider what the actual benefit you will receive is. Is it worth permanently reducing your lifetime benefits for a smaller, potentially reduced paycheck today? To answer that question, you really need to know what your cash flows are, how much money you'll be earning / receiving in retirement, how much you'll be laying out in expenses and taxes. Once you have those numbers, we can figure out the shortfall and do a cost-benefit analysis and determine with certainty what the right decision is for you. Something I like to tell my clients in retirement: in retirement, you get a battlefield promotion. Suddenly, you find yourself running a company, and like a company, you want to make sure that you don't run it into the negative. And like a company, you need to make sure that you hire the right employees. We have all experienced just how much damage a disinterested or incompetent employee is. In retirement, a bad employee can represent a lifestyle change. It is one of the reasons why I'm so adamant about teaching our clients. I'm not doing you any favors if I just wave a magical wand and give you a magical retirement plan. That won't give you confidence or peace of mind. Though you will sleep at night like a baby, waking up every 2 hours worrying. That's not really what either of us want for you in retirement. In my experience, the only way to have confidence in your retirement plan and to truly have peace of mind is by arming yourself with the knowledge you need to be able to evaluate for yourself and determine with confidence that you're in fact making the best financial decisions for yourself and your loved ones. Anyways, that's my goal, and if there's anything I can do to help you get there, don't hesitate to ask. Moving on, the Windfall Elimination Provision. So this is a sneaky little way that your benefits can get reduced. Notice how it's called Windfall Elimination Provision, as if this only affects people who have somehow managed to scam the system and shouldn't be getting Social Security, but somehow found a way to get it anyways. In reality, this only applies to government and nonprofit employees, like teachers and first responders. Basically, if you get a pension from what's called a non-covered entity, i.e. your job didn't pay Social Security taxes, right, but you later worked in a job that did pay Social Security taxes, then the government will reduce your benefits. The amount isn't huge, but considering that you probably don't have that high of a Social Security benefit, it could be a substantial portion of the benefits you're entitled to. Along similar lines is what the government calls government pension offset. This applies to spouses and survivors. So in this case, you worked in a non-covered job and your spouse had a private sector job, right? As a spouse or widower, you are entitled to 50% of your spouse's primary insurance amount. But because you're getting a pension, the government is going to reduce your Social Security benefits by up to 2/3 of your pension benefit. So basically, you give your life to the people, and in return, Congress comes in and backdoors your benefits. Which brings us to number 5, inflation, and the annual cost of living adjustment, also known as COLA. Let's take a break and talk a little bit about history. Inflation is the loss of buying power, or put it another way, it's an overall increase in prices. For instance, everything is more expensive than it used to be, right? A cup of coffee used to be 25 cents. Your house is probably worth more today than it was when you bought it. Inflation is that primary driver that is increasing those prices. When we're working, inflation is an incredibly good thing. It is how we can afford to buy that car or that house or that new TV. Slow and steady inflation allows businesses to borrow money at low interest rates, turn them into finished goods, which they can then sell to their workers who can borrow money to pay for them. And as long as you're in the cycle of borrowing and earning money and being the beneficiary of this inflation, the system will reward you. However, when we reach retirement, we are no longer in that earning phase of our life. So we need to make sure that our sources of retirement income are growing with inflation. Otherwise, we might discover that our hard-earned income has withered over time and we can no longer afford the lifestyles we once could. When we look at Social Security, the government gives us what's called a cost of living adjustment, or COLA. They give it to us each year. And each year they look at the core inflation rate for the country and adjust our benefits upwards. The only problem is that core inflation measured it excludes volatile items like food and energy. So gas for your car, heating for your home, putting food on your table, your check won't be adjusted for those. No, it will get adjusted for the increase in price of a washing machine, the increased cost of a TV, but not those essentials that you really need to live, because Congress has deemed them to be too volatile. I don't know about you, but being able to put food on my table is really important to me. So whatever you do, make sure that your retirement plan accounts for the rising cost of food, energy, and healthcare costs that are not covered by Medicare. Speaking of Medicare, your Medicare premiums will by default come out of your Social Security check. So when doing your retirement planning, you want to factor that reduction. The number on your Social Security statement may not be the amount you receive because of Medicare premiums. Something also to keep in mind is that your Part B premiums are based on the last 2 years of tax returns, which means you may want to try and keep your tax returns below $170,000 if you're married filing jointly, and $85,000 if you're not. Those are the thresholds for what Medicare considers high-income individuals who have increased Medicare premiums. Just another factor you need to juggle when doing your retirement planning. Okay, folks, I'm sorry we got on a little bit off track in this video and we've run out of time. In our next video, we're going to go over the methods for reducing your taxable income and maximizing your retirement income. And then we're going to discuss how do you bring it all together in a way that can maximize your Social Security and your retirement income and ensure that it lasts for your lifetime and your spouse's. Until next time, if you have any questions or if there is anything I can do, don't hesitate to text or email me at 516-400-4795 or email us at team@yieldsforyou.com. Have a great day, and remember, knowledge is power. Don't be afraid to ask the hard questions. Get the information you need to be able to retire with confidence and peace of mind. You only retire once. Get it right the first time.